Imagine holding the exclusive rights to a highly lucrative business model, but every time you try to expand, you end up competing against yourself. That is the exact paradox of operating a regional franchise network, where an identical competitor has the exact same menu, the exact same branding, and operates in your exact same territory. When two franchisees operate the same brand in close proximity, they pull from the exact same pool of store managers and the exact same local customers. This creates an aggressive localized rivalry that forces operators to lower prices to attract foot traffic, while simultaneously driving up their internal overhead. In the rapidly growing Indian market, this internal friction played out between two massive operators, Devyani International and Sapphire Foods. Both companies held the master rights to operate the Yum brand's portfolio, which includes global giants like KFC and Pizza Hut. This data visualization breaks down the scale of Sapphire's physical footprint leading up to the merger. Out of their 263 restaurants, 131 were positioned on high streets, and another 103 were located inside malls. Because both Devyani and Sapphire were highly concentrated in these exact same commercial zones, they frequently ended up bidding against each other for the same prime real estate. This artificial demand inflated commercial rents, capping the profit margins for both operators before a single meal was even sold. A fragmented franchisee model inherently limits how profitable a region can become. The dual operator system had finally reached its structural ceiling, and restoring profit margins required a massive financial intervention. The inefficiencies compounded at the corporate level. Both Devyani and Sapphire were spending millions of dollars annually to run separate, redundant marketing campaigns to sell the exact same buckets of chicken. This localized friction became a major operational liability in capturing the booming demand within the Indian quick-service restaurant market. India's rapidly growing middle class is driving immense foot traffic to fast food chains, but continuous infighting slowed down aggressive expansion. Capturing a larger share of the market required a shift from local infighting toward resource pooling. By successfully merging the two competing entities, they could replace the dual operator system with a single, unified national monopoly. This economic necessity drove the $934 million merger. By combining their operations, the franchisees could turn a highly contested battleground into a tightly controlled, highly profitable economic machine. On January 1, 2026, the boards of directors for both companies approved a formal scheme to merge Sapphire Foods entirely into Devyani International. This logic diagram outlines the financial mechanics of the deal. To consolidate equity without requiring a massive cash outflow, the companies executed a share swap. For every 100 shares Sapphire Foods, investors received 177 shares of the newly expanded Devyani International. Prior to the deal, the Sapphire Foods promoters owned 25.35%. To merge smoothly, this capitalization table had to be restructured. Arctic International agreed to purchase 18.5% of Sapphire's capital. The remaining balance was swapped directly for Devyani shares. With the paper equity consolidated, the companies began merging their physical corporate infrastructure. They immediately filed to relocate the registered offices of both entities to the state of Haryana to centralize corporate governance. These equity swaps consolidated the localized competitors into a single $1 billion QSR operator, placing more than 3,000 retail locations under centralized control. Pacing speeds up slightly, but financial engineering on paper only matters if it translates to physical assets on the street. The parent company, Yum Brands, actively supported the consolidation. They viewed the Indian market as a high-priority zone, and a single, well-capitalized partner is much easier to manage than two competing ones. This map of the Hyderabad metropolitan area shows the immediate physical impact of the deal. As part of the transition, 19 company-owned KFC stores in this region were transferred directly to Devyani, instantly painting the entire territory one unified color. By taking total ownership of the Hyderabad region, the newly unified company ended the localized rent and pricing wars in one of India's most critical growth markets. Ending the internal war directly impacts the bottom line. Every dollar previously spent fighting a mirror image competitor now drops directly to profit. This bar chart tracks the projected drop in operating expenses. By merging their separate supply chains and eliminating duplicate marketing teams, the unified company expects to generate annual operational savings between 210 and 225 crore rupees. That extra capital provides a massive tactical advantage. When prime commercial real estate opens up in a high-traffic mall, Devyani can now outbid any new independent restaurant operator without compromising its own margins. Operating as a single master franchisee at this scale creates a highly defensive position. Smaller regional food operators cannot secure the same supply chain discounts or afford the real estate required to compete with a 3,000-store network. In finance, this is known as a compounding moat, a structural business advantage that grows wider and harder for competitors to cross as the underlying company scales up. This transaction serves as a mechanical blueprint for aggressive corporate consolidation. It demonstrates how to take a fragmented, highly competitive territory and engineer it into a unified, compounding cash machine. While retail investors often trade on short-term quarterly earnings, the private equity backers and corporate managers engineered this structure to hold and dominate the Indian fast food market for the next 10 to 15 years. The result is a structure that ends a corporate war not by winning individual battles, but by consolidating the entire battlefield.